Hey, welcome back. Thank you so much for joining me. This is Mr. Market. We're now into episode 20. And thank you for joining me on my birthday weekend. Yes, if you can believe it, I'm now 48 years old. And, I got all the white hairs to prove it. So we had a little bit of a roller coaster this past week. The Federal Reserve raised interest rates by a quarter percentage point, as expected. But at the press conference, Chairman Powell basically said, no, we're not planning on cutting interest rates later this year, which is what the market expected. And so there was that disappointment, and it caused the market to drop. And, it kept dropping until we got a pretty strong jobs number on Friday, when jobs increased by, I think, over 230,000. And it put the economy in this Goldilocks scenario where interest rates are no longer going to be a headwind because the economy's been slowing down enough, inflation has been slowing down enough, yet jobs growth still remains strong. And I think that was just enough for the market to take it higher. So, the market was down significantly. I think it fell down as much as like 2.8%. And by the end of the week, it recovered on Friday about 2%. So by the end of the week, the market was down only about 0.8%. As for us, we actually had a bad week. I mean, relatively bad. We were actually up $18, but what can you do with that? You can buy a banana. So anyway, the biggest culprit for us having this bad week was that we had that exposure to the bank stocks. I mentioned in the previous episode that, hey, these bank stocks, they have a pretty awful trend, and, there's a chance that I could lose money on this. So I had a fairly small position, but they fell down so much over the past week that even a small position had a pretty outsized loss, which was enough to pretty much offset all the gains that I had made from selling the puts on the S&P 500 ETF. But, because I sized it small enough, it didn't wipe us out entirely, and I was able to just get away with it, with a scratch. So, it's a good reminder for the importance of sizing your bets correctly. Even if you have a trade that will go against you, if you can size it small enough, you'll still be able to live and fight another day. But I'll go to talk a little bit more about some of the lessons that we learned near the tail end of this episode. So, recapping our performance year to date, we're up $28,830, which puts us about 57% of our annual goal of $50,000 a year. And as a reminder, we are aiming to earn 20% a year off a $250,000 portfolio. Okay, let's talk about the market, and let's take a look at some charts. As you can see, the Fed raised interest rates by a quarter percent, and this is actually one of the most aggressive rate hikes that we've had over the past 40 years. And historically, when the Fed has raised interest rates, they usually do it to the point where the interest rates at least exceed the rate of inflation, and we just reached that level, which gives a little bit more strength to the argument that they are most likely done raising interest rates for the rest of the cycle and for the rest of the year. And once they stop raising rates, historically, they tend to hold rates steady for about 5 months before rates start to come down. And that usually starts to come down because of a potential recession. And you can see here, the market is expecting some pretty rapid rate cuts by the end of the year. Going forward, if we take a look at how markets tend to behave a year before the election, we're kind of entering a period where things tend to just be choppy, and you get some sideways action with a mild, slightly upward bias. And that also brings to mind this common saying on Wall Street, sell in May and go away. And that comes from the historical performance of the stock market, where it tends to have the weakest performance going from May all the way up until October. So May and June tend to be pretty dull months, and then you get a little bit of strength in July, and then August and September tend to be pretty bad months as well. So we're entering this period where historically things haven't worked out so well for the market. And given how close we are with the debt ceiling issue, Janet Yellen just told us that the xdate, the date when the government is expected to run out of money, has been pushed forward to as early as June 1st. So, that is about 3 weeks away. And if 2011 is any guide, the market starts to get nervous about 2 weeks before the deadline. So that would leave this week as the last week before things could potentially get a little bit more unstable. The bond market certainly feels it. If you take a look at the yield curve for these bonds, right about where that xdate is expected, bond yields have spiked significantly. I'm a little bit nervous about it myself, so I'm trying to steer clear of owning bonds that mature right in that June deadline period. Will those knuckleheads in Congress figure something out before the deadline? Probably, but it's probably going to come down to the wire. And I think because the market is a forward-looking mechanism, even if we get a deal, the mere possibility that they might not have a deal by the deadline could cause the market to fall. And so I'm going to be a little bit more defensive after this week. And I am probably going to hedge my bets a little bit more by selling some calls to go offset my puts. In case the markets fall, at least I'll take something down with me. And speaking of the bond market, if you take a look at the 10-year bonds and compare it to the yield from 3-month bonds, we have what's called an inverted yield curve. And the deeper this negative number is, the more likely that we are going to fall into a recession. Now, it certainly doesn't feel like that with the stock market acting well, but historically, when you have had this type of inversion, you've gotten a recession within about 12 to 18 months. And so there's some expectation that we'll finally go into this recession, albeit a shallow one, at the second half of this year, which is not too far away. But the thing that's really problematic is that the volatility index, the VIX, also considered the fear indicator. It's extremely low, especially given the circumstances for where we are in the economy and where we are with regard to the whole debt ceiling issue. Historically, there tends to be a pretty strong relationship between the probability of recession and the volatility index. When the probability of recession goes up, the volatility index goes up as well. But in this case, we've had quite a bit of a divergence, and there's just very little fear out there. And that is one potential air pocket that could cause a lot of mayhem in the stock market. So got to be careful here, because once that VIX starts to go back up again, it could be the triggering event that causes those two charts to finally converge. And if that happens, it could spell a little bit of trouble for the market. And there's some other things that are a little bit more troubling. If you take a look at the projections for GDP growth, you can see it's falling, but at the same time, the expectations for the earnings growth for the market are rising. So we have another divergence here, and that's a problem. But one thing that could explain it is that the S&P 500, it's really driven by the biggest companies in it. This is called a market cap weighted index. So the bigger the companies, the more influence that they have over the overall index. And if you take a look at the performance for the market, it's largely been driven by the top 7 growth stocks in that index. If you take out those top 7 growth stocks, the performance is actually pretty crummy. So a lot of these companies that are driving it tend to be a little bit more recession resistant. So even though we have the recession indicators out there that affect the majority of the companies in the S&P 500, the companies that are really driving the index performance are a little bit more resistant, which could be the explanation for why things are still holding up a little bit better than expected. Okay, let's talk about those bank stocks and why I lost money on them. Okay, so last week I showed that chart on KRE, the bank ETF, and that had a pretty solid downtrend to it, but I still held on to it. If you take a look at that chart, there was that short-term downtrend that got broken, and then as the days progressed, it started to break down a little bit further below the old low. And when that happens, our rule is we need to redraw a new trend line that accounts for that new downtrend. So once that happened, the downside risk actually just expanded exponentially. And if I had been much larger, I would have been forced to reduce my bet sizes significantly, because that is a sign of growing risk. But since I had a small position, I didn't adjust my bet size, though I could have and should have, but I didn't because I wanted to see how things were going to go. The bank stocks are definitely cheap, and whenever you have an area of severe panic, that tends to be closer to the bottom. But one of my observations is that, for stocks, when you get near the lows, ironically, that's where some of the biggest losses happen. And just like, when you have periods of euphoria, when you are near the highs, that's where some of the biggest gains happen. It's just one of those strange things about the market. The market, I'd say, is about 40% rational and fundamental, and the other 60% tends to be a little bit more emotional. So, you could have all the data and take a look at the fundamentals and say, yes, this is what stocks should be doing. But based on my historical experience, that only accounts for less than half of what actually drives the market. So you're not seeing the bigger picture. You need to account for the emotional side of the market. I'd say about 60% of it. And that is fully captured in the charts and in the trends. So when you have two things that are going against each other, you have a fundamental picture that suggests one thing, and you have an emotional picture that suggests another, you need to respect what the emotional side is saying, which is what the chart is saying. So you need to respect the charts, and you need to wait at least until that downtrend is broken before you act on it. The bank stocks looked like it had this huge volume spike last week, which tends to mark short-term bottoms. It could also be something called a dead cat bounce, where something crashes and then has this short-term bounce and then fades right back down to its old lows, which is a very real possibility. So I do still have some of this. I rolled down my strike prices from 40 to 38 to 35, and I now have my puts at the $35 strike price level. And if it gets back down there again, my bet sizes are still small, even smaller than last week. But if it gets down to the 35 level, I will keep rolling and rolling and rolling, just as an interesting experiment. So one of my other weaknesses with this trade had to do with a behavioral finance concept called confirmation bias. That's when you are looking for everything as much as possible to go confirm your thesis on a stock. So yes, even if you have all this negativity, you're looking at any data point that you can, just like, JP Morgan Chase's Jamie Dimon. He said this past week, oh, that crisis is over. And lo and behold, as soon as he said that, stocks just took another beating. But, it's little things like that. And, like Barron's. Barron's had that headline a couple of weeks ago, buy the big bank stocks. And, you use that as little justifications to hold on to your position, even though you see a deteriorating chart. And when you do that, you need to keep respecting the chart because, again, the emotional side can overwhelm the fundamental side. And in this case, that was exactly what happened. So the lesson here is don't listen to what you want to hear, but pay attention to what you see. Don't ignore your eyes, but do ignore your ears. Okay, so for this week, I have puts that I sold at $400 and $395 for the S&P 500 ETF. Plus, I also sold some calls at the $420 strike price. And I am going to be a little bit more cautious, as I mentioned. Once this week is done, we're going to enter that 2-week period where things could get a little bit more unstable if we don't get a deal from the debt ceiling. So I have puts and calls so I can benefit from either direction that the market goes. So that's all I've got for this week. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my videos drop. You can also visit me at my new domains that I bought, mistermarket.us or mistermarket.us. Good luck trading this week, and I will see you next week.